Today, we wanted to talk about the rising interest rates and the effect that this may have on a fixed-term mortgage, especially if your fixed deal is due to end in 6 to 12 months. The question is, do you change your deal now with an early repayment charge or hold out hoping for a lower rate in the future? Hello, welcome back to our channel and podcast. My name's Gemma, and here at WS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Ifti joining us once again. And for those of you who don't know Ifti is a trained accountant and mortgage advisor who's been in the industry for over 11 years, and he is also one of the founding directors here at WIS. Welcome back, Ifti. How are you doing today?
Hi, I'm very well, thank you. How are you, Gemma?
I'm very good, thank you. Today we're going to be talking about something that we're getting loads of questions about from our customers, rising interest rates. And this is kind of really is a good point. A lot of people are on fixed rate deals and, you know, they're sort of umming and ahhing. Oh, should I change now before the rate gets too high? So let's get this question out of the way. Is it a good idea to break your existing mortgage and get a new deal?
Well, the answer to that is it depends, right? That's the answer to that. Yeah, I mean, it really depends on each person. There's no blanket answer to that. Unfortunately, I wish I can give you that answer. Like you said, right, if somebody's on a variable rate, I think you touched on the fixed ones. If somebody's on a variable rate, if interest rates are rising, it may be a good idea to fix it because obviously the interest rate is on the rise, right? We can't predict how the interest rate is going to be in the next few months because that's something, you know, the banks and the Bank of England, they kind of decide, but it's not us, right? But there looks like there's a trend of the interest rates increasing. So therefore, if you're on a variable, it may be an idea to fix your deal, right? Again, if you want some advice on that, speak to an advisor. Of course, we are always there to help you because there's no hard and fast rule when it comes to these things, right? But if you're on a fixed rate, that's when it becomes a little bit more tricky, right? It's tricky because most of the time these variable or the tracker deals, they do not have an early repayment charge, right? So if you break it, you don't pay a penalty to the bank. So that's what it means. But when it comes to a fixed deal, it's slightly different because you have something called an early repayment charge you may have to pay the bank. Usually how it works is, again, this really depends on the bank. If you take a 5-year deal, in the first year you pay a 5% penalty on the loan outstanding. Second year it drops to 4, then it goes to 3, 2, and 1, right? So that's how it works. Every year it just drops by 1%. But some banks say, okay, throughout the term it's a 5% penalty that you have to pay, or early repayment charge you have to pay. So that's where you have more problems, right? So yes, it's probably worth looking at options. So, you know, if you have a deal like that, maybe coming towards the last year or whatever it is, it's probably worth having a look at that to see whether breaking it now and putting it on a better deal may be a good idea, because obviously you might pay 1% interest, but at the same time, if you're going to save money on the long run, it will be helpful to you, right? So it's always worth reviewing that option, right? For some people it may work, but for some people it may not, right? But I think you raise a very valid point when you had this conversation. A lot of banks, especially if you're in the last year, offer mortgage offers which are sort of valid for about 6 months, right? So if you're in that kind of space, it might be worth looking at it anyway, because you can now fix the deal and you know that the mortgage offer is valid, right?
Yeah.
This is what I always tell clients, right? We don't have a problem if interest rates drop, right? Because we can always, if you haven't completed your deal, we can always switch to a better deal. But the problem is if the interest rate goes up, we don't have control over that, right? So we just can't do anything about it, right? So yes, so I think it might be a good idea for people to start looking at their deals a little bit earlier than usual, right? I mean, I encourage a lot of our clients to do that, and I think a lot of people have benefited from that. So it might be worth looking at that option.
Getting your mortgage online doesn't have to be complicated. At WIS, our website will help guide you through step by step. Our fully qualified advisors can help you get the most suitable mortgage for you. Then you can relax, safe in the knowledge that WIS are working in the background to get your mortgage approved. WIS. Online mortgages made simple.
And just talk us through the process. Like, normally, how do we work out whether it is a good idea to settle or break the deal now?
Okay, so it's not a very easy calculation for sure. If you're not sure what you're doing, I strongly suggest you speak to an advisor on this, right? Firstly, you need to see your break clause, right? So if you break the deal with the bank, how much you're going to pay, right? So for example, if somebody is paying, say, 1% break clause, and let's say the penalty is £1,000, you need to start comparing it with the amount you are actually going to save, because you're moving to a different deal, right? Because all what you're trying to do is you're worried that come 6 months or a year down the line, the interest rate might be 3% as opposed to 1% which you are paying now, right? 1% which is the current market rate, right? So if you take an example like that, if you're expecting interest rates to go up that much, maybe it's worth paying that 1% extra. And because obviously in the long run, you're going to pay saving 2%, right? So maybe it's worth paying that 1%. But that calculation, this is why it becomes complicated, because you need to add things like there might be legal fees you have to pay. There might be exit fees you have to pay apart from the ERCs. So those need to be added as well. Some people pay broker fees. Obviously, we don't charge a broker fee, but some people do that. So you need to include those as well, right? So I have got a spreadsheet. If somebody is interested, please, put down on the comments, and I'm more than happy to share that spreadsheet. That will give you a guide to see whether it's a good option for you. But like I said, it's a bit more complicated than that, because we are trying to predict what your interest is going to be in the next few months as well, right? Because we are trying to predict, right? So now that is a crystal ball question, right? So you really don't know the answer to that. So you need to take that also into account. But that's why I said this might help you as a starting guide, the calculation formulas which I can send you. But you probably want to seek advice before you make this decision, because it involves a 1% penalty if you're in the last year for most mortgages, and sometimes it's even more, right? So, you probably want to get guidance before you do that.
Definitely. So let's talk more about, sort of variable deals. I don't feel like you hear as much about variable deals. So would you say they're a good idea or not?
Generally, if interest rates are going up, variable rates aren't the best option, because obviously variable rates are sort of connected to Bank of England base rates most of the time, or it's connected to the standard variable rate because they give at a discount, right? That's called a discounted mortgage. So there are slight variations on some of these variable deals, but the most popular one is the tracker. That's the most popular one and widely available variable deal, right? So with trackers, it tracks your interest rate with the Bank of England base rate. So if a tracker rate is 1% above Bank of England base rate, if the interest rate goes up when the Bank of England declares the interest rate going up, this will go up as well, right? So that's kind of what it is. So that's a little dangerous in a situation where you think interest rates are going up, right? Because obviously your monthly payment, you don't really have too much control over that, right? Because it's dependent on the Bank of England base rate, right? Now, saying that, I mentioned this earlier as well, a lot of the tracker products out there does not have an early repayment charge, right? So for some people, it might still work, right? So for example, let's say I'm buying a house, but I'm not buying a house now. I'm buying a house in a year's time, right? So I don't need a 2-year deal, because most of the banks don't offer a 1-year deal, right? They offer 2 years, 3 years, or 5 years, right? So they offer deals like that. So if you fix yourself for 2 years, that means after a year, you still have to pay a penalty to come out of it, right? So for people like that, the tracker might work, right? So that's why I said, there's no blanket answer to these things, right?
Yeah.
So you definitely, if you have certain circumstances which you think might affect your mortgage, at that time, you definitely need to get some guidance, right?
Yeah, definitely. And what about then, a fixed deal? In this current climate where we're at now, we can see sort of, where the economy seems to be going.
Yeah.
Would it be a good idea to perhaps do a fixed rate, would you say?
I mean, for most people, it'll be yes, right? Again, we got to look at circumstances for everyone. But for most people, it'll be yes. But the problem is, for how long is the biggest question, right? Because I see a mad panic where people are actually trying to fix their mortgages for 5 years. Some are saying, can I have a 10-year mortgage? Yes, we can do that. The interest rates at the face of it looks okay. It looks cheap, right? But it really depends on your circumstances, right? Because let's forget everything else. The question you have mainly today is, should I break my deal and fix myself to a different deal now, right? Now, if you're on a long-term deal, I'm sorry, that option is unlikely to be viable for you, right? Because, if you got 3 years to go from now, you're probably going to pay a 3% penalty. So it's no point you breaking the deal, right? So do you really want to set yourself up to a longer-term deal? is a massive question, right? If your circumstances are very predictable, say, I'm close to retirement, I don't have any intentions of moving property, I don't have a massive mortgage to pay, in circumstances like that, maybe yes, it might be good. But if somebody's not sure where they're going to be in the next 2 years, not sure where they're going to be in the next 3-4 years, if they have kids who have to go to school, if you're sort of thinking of secondary school, if you're thinking you may actually have to upsize later, for people like that, longer term deals may not work, simply because they have to pay this penalty, right? So be careful in trying to fix that, right? Like I said, there's no right answer for everybody, right? There's no standard answer. It really depends. This is where you really need some guidance, right? So you need to speak to an advisor. Obviously, we as brokers, we advise. There are the brokers out there. There are some banks who offer you some advice as well, right? But if you have circumstances like that, you definitely need to speak to the bank. You make sure you're doing the right thing, right? So, yeah.
Yeah, definitely. Oh, well, thank you again, Ifti, for some more great advice. I just wanted to put our regular reminder out there that these points may or may not be applicable to everybody. So if you're unsure if they're suitable for you, then please do check with an advisor. And if you don't have an advisor, I will leave our WS contact details below, as we are always more than happy to help. A little reminder that as a mortgage is secured against your home or property, it may be repossessed if you do not keep up with the mortgage repayments. Thank you for joining us again today. We hope to see you next week. Have a great day, stay safe, we'll see you again soon.